recording for me. Oh,
Yeah, my bad.
now it is. No problem. Banks today are massively risky institutions, often failing, causing financial crises, causing the bankruptcy of companies and other industries, and massive damage. Neurobanking will uniquely solve this, massively improving the stability and overall outlook of the economy, saving people from unemployment, from losing their homes, and from massive financial damage overall. For these reasons, we are going to propose that. Before I get into our main argument about bank failures, I'm going to do two things. A, I'm going to frame who and how much are going to opt into equity and who is going to stay in more traditional government-backed bonds. And second, talk about why there is still going to be sufficient money for loans, for things like mortgages, for companies, etc. Before that, just one point of framing. We think it's reasonable to assume that in stable countries where the local government bonds are reasonable investments, banks will invest a lot in their local bonds. Other places they might invest in American bonds or German bonds or other countries that are stable and have reasonable bonds. We don't think countries that have bad finances themselves are a problem within this debate. Let's talk about who is going to do so and how much. I think most people don't want to see the balance in their checking account changes. It feels risky. It feels like you can lose this money that you're reliant on. Most people don't have massive spare amounts of budget, so they actually depend on that. They can know exactly how much money they have. That means that at the point in which, unlike today, when the bank gives out loan investment and the value changes, you actually see the change within you. It feels much more risky because it's visible and you are unlikely to want to do so. Note, banks are unlikely to be allowed to push this on you because you have fiduciary duty to do what is best for you, and they probably can't justify forcing people into buying these accounts. Second, we think it's important to note that banks today already pay basically zero interest rate on deposits, so we don't think it significantly changes the amount of money people are getting on those deposits to any significant extent. And on a second level, if people want higher rates, they can always invest in other things today. They don't have to put their money in deposits. We don't think this changes significantly. Who still does equity accounts? We think the people who still do equity accounts are people who they invest in stocks, people who they buy bonds directly. People who want actual investments are going to have this extra option. It's going to be an equity account where they know they're actually allowing the bank to make decisions for them and decide whether they think the bank is a good financial manager or not. Look, we think at the most basic level, these people are much more aware of the risk, and therefore much better for them to be doing this thing. On a second level, we think we're still going to have sufficient amount of money for any kind of loans we want to make. Look, if the bank buys more government bonds, which are safer, more stable, more liquid, and less likely to change their value, and therefore less putting the bank at risk, that displaces other buyers of government bonds because it increases the demand for government bonds, it lowers the price of government bonds, and therefore places would have bought government bonds before and would not do so now, right? So if we're talking about hedge funds, if we're talking about other investment companies of large scales, all of which are going to want new places to put their money at. We think it's very likely that they will use this to either originate loans or to buy bonds from companies because they already do so today, right? Many companies get loans from such institutions. We think beyond that, there are pensions funds, insurance companies, and massive number of other economic institutions that want to originate loans and are perfectly happy to give money to do so. We don't think there is going to be a massive problem here, especially because mortgages are highly profitable because they are backed by the state in most cases, which guarantees they are not going to go bankrupt to a large extent because they're giving extra security so the loans are long term. Let's talk about bank failures and why this changes massively. Look, bank fails in a very simple way. If the value of assets fall below the value of the deposits, the bank can't pay back its depositors. They often find out because banks are public institutions, have to file quarterly reports that make it visible that they don't have the assets to pay back. The depositors pull out their money, and some people are left holding the bag because they don't have a sufficient amount of money. Why does this change in our world? Look, if you have an equity account for all these loans, if the value of the assets falls, the value of the equity account itself falls, and the bank never finds itself in a case where it has greater liabilities and it has deposits. This is massively important because the bank is massively likely to find itself in such a case. Look, at the most basic level, there is the issues of financial crisis in other industries. There are natural disasters, there are wars. It happens all the time. Silicon Valley Bank and First Republic Bank went bankrupt in the US just 2 years ago. We see large banks going bankrupt due to drastic changes that are happening fast because the underlying assets are so volatile and loan change so often that it's massively difficult. We think on a second level, there is a massive moral hazard problem for bankers. Bankers' bonuses and income and career success depends on how much success they're having on their investments and loan today, because this is what makes money for the bank. That means bankers want to maximize the amount of money they're making. importantly, if they take risky assets that are going to lose money in 5 years, mostly it's not their problem because they will already be promoted. They've already gotten their bonus. They might well be in a new job. So the default cost for them is much, much lower, especially because usually when there is a crisis, it's contagious because it creates panic. You have to sell assets, lowering the value of the assets for all the other banks, bringing all of them closer to crisis, all of which means it's likely that all the other bankers are equally at fault and they all feel good about it because everybody's getting personal blame for it. Well, if you underperform the other bankers in real time, you're going to be hurt. But it also means that banks have massive incentive to lobby to lower the amount of regulation they have today. Look, banks have a lower investment to lobby to lower the amount of capital requirements they have. They have an incentive to lobby to regulate every regulation they have so they can get more risky loans and maximize the amount of money they have, knowing that if they fail, it's the depositors left holding the bag and not themselves. They're not the ones losing the money. On the comparative, they're just not allowed to use this depositors' money as long as it's an equity account, which I think the vast majority of it wouldn't be, which would massively increase the safety of those banks. And look, when a bank fails, it means that every company that is reliant on this bank for a line of credit is not going to be able to get that money. Before I continue, a few ICO.
Why are banks likely to not fire this person even if they made this decision in the past when they know they could make this potentially risky decision again in the future?
Look, we think that when you have lots of, it's a system of incentives. So we think many bankers are doing it all at the same time. So you don't think it's likely the bank just fires all its bankers. Second, if something has happened 5 or 6 or 7 years ago, and look, mortgages and loans are often 20, 30 years, it's likely you move to a different job. A third, banks are massively competitive and they fire the worst performing 10%. You might well be willing to take the risk of being fired in 5 years if you're not fired today. We don't think this is a good answer to this debate at all. Look, why are banks failing such a massive harm to the world today? Banks are just responsible for credit lines for many, many people, right? Many people are reliant on the ability to get money from the bank and another deposits in order to live the day-to-day life. More than that, many companies are reliant on the bank they have that they know they have a relationship with to give them money when they need to make investment or buy new factories, etc. All of which means that if a bank fails, it can't renew loans. It has to call back all its loans, sell all its assets. It's going to cause companies to fail around it. It's going to fire its own employees. It's going to get other companies to fire other employees because there is no money. It's going to generate unemployment and massive amounts of damage. And for all of these reasons, we call on you to propose.
I thank the speaker for the fine speech, and I invite the Leader of Opposition to win a case for opening opposition. Hear, hear.
Oh wait, I was muted. Sorry, I'm an idiot. Can you hear me okay?
Yep.
Okay, amazing. Okay. The prosperity of the modern age was built off the back of all of us. We worked together to build functioning systems, to give the loan that brought your business off the ground and opened the keys to your first home. GovBench guts the ability for these things to happen. Banks are the ones who are giving out the loans that everybody receives and the largest source of investment into the economy, which is being gutted on their side of the house. 3 arguments. Firstly, why is status quo the most sustainable and effective method of banking? 3 observations under this. Firstly, the number of people who are going to put their money into equity accounts will be remarkably low. Who is the character of people who want to invest? It is usually people who want to make money off of their savings for things like retirement or to be able to get a home to the future. And these tend to be the most risk-averse consumers. So Gov can't claim people try to enter investing who fear risk, because that is the very group of people who we're going to talk about right now, because other people would just put their money into brokerages anyway. How do they tend to act? Firstly, they already invest through alternative means. They have retirement accounts through the brokers in their workplace, like a 401k. They use investment apps and like brokerage services, like Vanguard, for example, that promise low risk, where they buy treasuries themselves or be happy with a treasury-backed account that prop stands over. Why are these alternative means to these people preferable to equity accounts? Firstly, flexibility. You can select firstly for your own values. There's BDS consumers who want to de-invest, for example, from Israeli companies, or flexibility for your risk tolerance. Some people want more risk than others. Even if a bank is like systemically low risk, then there'll be some people within that want high risk. They are younger, so maybe they'll select by their age for a mixture of higher risk and lower risk investments. And that adjustment will change the older and younger that you get. And so therefore, you're able to adjust for your risk tolerance specifically through being being able to invest through an alternative actor, which you cannot do through an equity account. Secondly, ease of startup. It is hard to commit to investing. It is scary. You worry about losing your money. So brokers having this control and taking the step in for you, or the fact that your money was being invested through your retirement 401k without you having to take an extra step, is already one of the most immediate ways in which a lot of money is invested. Why is this important? And this is maybe the most important thing you'll write, panel, so please write this down. In status quo, the majority of invested and loan money comes from banks. Every cent in your bank account is mostly being invested somewhere else. This is how our economy functions. The comparative isn't invested versus uninvested money. It is invested money versus all of it in government bonds. Now, even if a decent number of people take equity accounts, the volume of money in the economy is absolutely gutted and shrinks to a fraction of what it is. Second observation, why is there no systemic economic risk? We support the status quo of fractional reserve banking along with significant regulation. 4 observations under this. Firstly, 128 different countries around the world have deposit insurance, including all but one OECD country. Hong Kong gets 100% deposit insurance, where banks pay an insurance premium to a government body every year in exchange for a guarantee that in the event of a failure, depositors will not lose their money, and so therefore people do not lose it. And that immediately means that the harm to regular depositors does not exist. They're protected in the case of a bank failure. And we usually don't get bank runs as a result of this. Depositors know that even in the worst case where it collapses, their money will be protected, and that when a bank run does occur, the FDIC or the ECB can step in and guarantee the deposits. We saw this in the case of Silicon Valley Bank, where the government stepped in and guaranteed every deposit in the bank. Secondly, capital requirements. Banks must hold a proportion of their deposits in the central bank, around 10%, and they're strictly limited in their ability to purchase risky assets, which reduces the risk of a solvency crisis. 3, there's liquidity requirements. They're adopted in the form of regulations known as Basel III. With liquidity requirements, banks need to hold about 20% of their total assets that can be easily turned into cash, like high-quality government bonds that they can easily sell in the case of a liquidity crisis. But fourth, if that happens, central banks act as lenders of last resort. So they lend banks that are suffering from a crisis money, backed by the bank's illiquid assets. But finally, these regulations are going to be maintained into the future because they're under long-term public scrutiny. So even if the 2008 financial crisis happened a long time ago, the impacts were so visceral, the fear of you losing your home, that you want to prevent that from happening, and that would make any party inherently unpopular, even if it isn't of their direct causing. But also because they want to avoid having to do bailouts, which are incredibly unpopular because they come from taxpayer money and limit your ability to pursue your agenda on any other policy. Even if there's lobbyists on Gov, as Roy posits, this is not enough to offset the risk of a career of any individual politician, so you would rather take money from any other lobby. This is also, trivially, why in the US and UK, where the largest banks are, banking bonuses were banned in 2009, addressing their biggest concern. Third observation, the investments that banks made in status quo are both safe and making money. Reality check this. Risk is dangerous for banks, meaning they have massive incentives to mitigate it. In terms of loans, it looks like demanding depositors to show their credit history and collateral while making loans. In the case of investments, banks have been putting their money into safe assets. They have huge amounts of money to lend because their customer bases are huge, like HSBC or Citigroup being some of the largest banks in the world. So even if the assets themselves are less speculative, the small percentage they make out of them still translates into huge profits given the large amount of money that they invest. Think about who actually makes these risky investments that Gup describes. Actors like hedge funds who have smaller overall pools of money and therefore need to take on riskier trades to get the same profit. Banks independently make good decisions, and this is evidenced by the fact that the majority of banks do not fail. The conclusion of all of this is that we have functional regulations that prevent banks from making risky investments. But even if you don't buy that they're foolproof, banks independently have incentives to avoid these things. And some risky investments are made on aggregate that is able to mean that the market will grow and banks still make returns. But even if you don't buy any of that, we have impacts that prevent potential failure. Second argument, narrow banking will cause decreases in investment into the economy. Banking in the status quo allows banks to easily access capital, ensuring they have far more money to reinvest into the economy. Through this reinvestment and economic growth, the everyday person's life becomes better and financial crisis becomes less likely and less damaging. Why does investment occur? Firstly, banks loan out far more funds under the fractional reserve system. They have capacity in terms of the volume of funds which they do not on their side of the house. But secondly, more loans being issued creates a cyclical feedback loop where companies are better able to pay them off with interest to the banks, and the client's success increases the capacity of the bank to make loans in the future because the client does well. The impact of this is we get more investment into companies, which increases economic growth. Investments into companies from banks is critical to growing the economy and increasing the consumer spending. With more loans, they can issue more shares and get even more money. They can invest into more factories, more innovations, better employees. And even when companies are not issuing new stocks, investments from banks affect their stock value. This is because their company is perceived and is more lucrative. Share prices rise faster, and companies can pay increased dividends to shareholders. The higher the stock price, the easier it is for companies to take out loans as they have more stock to offer as collateral, and the risk of defaulting is less likely, but they can sell the stock to recoup their losses. Closing.
Yeah, sure. Rationally, if banks had to suffer the losses that you're talking about, then they wouldn't be too risky. But the fact is the government's bailed them out before, so now they have the expectation.
Yeah, it happened once. SVB did not need that level of intervention because their depositors were covered. This is just not true of the vast majority of banks. Why does growth decrease on their side of the house? Firstly, the competition for small amounts of capital increasing means there's higher loan costs so businesses can access them. But secondly, bank loans at higher rates and loans them out at higher rates and less to fewer businesses and fewer mortgages, because the risk if they don't make a return on it is far higher. Just think about this. If I have 100 pieces of candy, you taking one from me is a loss I could write off versus if I had like 10 pieces of candy only. The growth is far larger and more important than the minimal risk of financial crisis on our side. We've already demonstrated that it's an incredibly low risk, and given this, we should prioritize growing the economy and ensuring that there's more jobs for workers, more innovations to help consumers, and a better quality of life for all. Their alternative is hedge funds. Who funds those? They don't get money out of nowhere. It's either money that's invested by banks as one of their instruments for higher growth, or for private investors that are far poorly regulated. Finally, we preempt the possibility of financial crises. They may happen on both sides of the house, even if they're not caused by banks who are taking out deposits. But more loans mean that crises won't be as severe. Firstly, because many financial crises are caused by a lack of access to capital. By making it easier to ensure growth on aggregate, that means that it remains constant, there's capital access, so the scale of crisis is far smaller. But finally, when banks have the capacity to make more investments, they can bundle risky and safe investments together and offset those risks into the future. For the sake of opening the keys to your first home and saving people from the worst degrees of crises, we are remarkably proud to oppose.
I thank the speaker for the fine speech, and now invite the Deputy Prime Minister here.
Just making sure, am I audible?
Yep.
Yeah, amazing. Cool. Okay. Starting with a few responses to OO, then a lot about what is this instability and collapsing of a bank is not only likely, but damaging for the majority of the population and creating irreversible harm from them. Then lastly, just weighing it directly versus the businesses and housing market. Look, we think that what we get from OO at the beginning is that some people want to invest, enjoy it, and benefit from it through several, apps, companies, and all of those people, by my partner analysis, can still decide to do it if they want. They can, if they are young and believe that it's okay for them to take the risk, they can come to their bank, they can find other companies that can find those apps and do it. If it's people with extra money who just want to take the chances, great. This is still something that they can do. The only difference is that now we are not forcing people without ability to choose to do it. We're not taking the little money that people have and putting it in high risk. The only thing that we are doing is forcing people to make this decision, to make their decision about their own money. We think this is something good. We think that this is something that doesn't create the harm that O is talking about. Secondly, we think that when OO tell you that in the majority of cases, people don't lose their money, they tell you two stuff. First, the government is going to bail them out. And then they tell you, no, but they don't bail them out enough for them to decide to take the risk. Decide. If they are bailing them out in the majority of cases, then they're going to take the risk, then they're going to do more and more risky stuff, and the government is going to bail them out. If not, then the majority of people are getting harm and damage every time we have instability, every time that the bank collapses. And look, even if you buy the thing that in a lot of cases the state bailed them out, this is not a solution. This money doesn't come out of nowhere. This is pay taxes money that people, everyone in the state, paid for the government. This money was supposed to go to education, to healthcare, to better infrastructure. The fact is that this money is not going to the bank out of nowhere. It is money that actually been taken away from other stuff who could benefit those people. That means that people are actually losing money. This is money that could have improved their life. This is money that could have improved their everyday life. Just don't think that in this case, the fact that there is no arm to collapse because of the debt actually stands. And when we are talking about the collapse itself, we get one major attack. They tell us lobbying isn't that severe because there were regulation against it. But look, first, we just still see it happening. We think that the fact that, as I told you, 2 years ago we had a collapse of two banks mean that this is still happening, and this lobbying and this regulation isn't enough to stop it. But more than that, the politicians have an extremely short-termism. They want to get more money from the banks as a donation for their campaign, meaning they have huge incentive to actually help those banks, huge incentive to actually oblige to what they are telling them to do. All of that mean that we think that this lobbying is still exists, still able to reduce the regulation drastically. But even if you don't buy this, my partners still have 3 different mechanisms who still standing. All of that, with the actual fact that we see every couple of years, this collapse is not something that happened once in a lifetime. It happened several times while I was alive. That means that it's not something that is so rare. It's something that happened every couple of years, something that everyone is facing over and over again, the current measure isn't enough to stop it. All of that mean that all the impacts that we are telling you still stand. And what are the impacts? We think that we have those impacts in the state level and in a personal level. So let's start with the state level. First, we think that we have huge chances of a snowball effect because banks take guarantees from one another. They have loans from one another, meaning that one bank start to collapse, more and more banks starting to collapse. So that means that any time that we have instability, every time that we have collapse, you just increase the extent for other banks in the state, for other banks across different states, meaning that every impact that you're going to have is creating much larger extent. But more than that, we think that we lose the ability to operate for entire sectors. Their ability to pay for the worker is diminishing because they lost the money for their loan. The fact that several companies don't have the ability to pay to suppliers means that not only the specific sectors are getting harmed, but more and more sectors will support them. I think that companies themselves become bankrupt. So for every company that or any opposition try to tell you that is unable to build, we think that this is mean nothing if those companies will collapse after 1 year, after 2 years. They're unable to create their product, they're unable to create anything good. Lastly, we think that in the state level, the trust of different investors is drastically diminishing. Why? Because they see that they can't trust the bank, they see that it's extremely volatile what's going to happen, and they fear that another collapse might happen soon, or that a bigger collapse would happen right now. So more and more banks will collapse. So that means that inner investor and outer investor from other states don't invest enough. That again means that we don't get more investment to businesses, we don't get more stability for the currency of the state. This creates a long-term effect because it takes a lot of time for the investor to again gain trust of the government. Lastly, we just think that, as I already said, the shift of this state funding for bailout means that we're not getting enough stuff for the public, if it's social welfare, if it's actually the ability to create infrastructure, education, all of those stuff. I think this is drastically a problem that's affecting everyone there. But we also think that we're creating problem for the personal issue, people. The fact that people actually lost their jobs because the company itself don't have money to pay for them, that the money that they wanted for their own retirement is now gone, meaning they don't have enough time to get back to work. Some of them are extremely old. Their businesses collapse, meaning they're unable to create new businesses there. They just don't have ability to live their life in dignity, send their kids to school. They have an inability to actually function in after. I think it is affecting everyone, not only the rich businessmen that things that are creating more businesses, the only people who are actually enjoying more and more money getting from those investments. I think it's affect everyone, that people that have no other ability. Before I continue, I will take a second. First.
Opening?
Yeah, second.
So banks don't have the incentive to want these things to fail because they know that it'll come back on them in the future. But even if not, deposit insurance isn't the same as a bailout.
Look,
one of these things is far more affordable.
one POI you said, and I will respond to the first one. Look, my partner already analyzed the incentive. They get money if they get money anyway. They have no risk. No one is going to fire them. It takes a lot of time to understand that they are the one who did the wrong thing. Even if they understand this and they fire the person, the damage for all of the population, for all of the state already happened. I think this is just less important. We think that they still have the incentive. Look, I think this impact is enough to win because the amount of people that are affected, but let's compare it directly to businesses too. My partner already explained to you that the delta here is extremely small because those businesses have, or a housing market has different ways to get this. We have big firms that will want to invest, rich people who want to build those firms and gain more money from it. We have pension funds who are able to invest in those other businesses. We have government which create those investment for companies. All of that to me, you just don't think that the delta that you get from opposition is that big. But also, know that you just think that the thing that are affected on our side is not only the new businesses, but also existing businesses, meaning that more jobs are getting let down. I think that having existing businesses who are surviving and giving the predictability for people and their stability is more important than having some new kind of business that you just don't know if it's going to succeed or not.
I thank the Speaker for the final speech. I now invite the Deputy Leader of Opposition here.
Can I be seen and heard fine?
Yep.
Yeah, awesome. 1 second. If we were having this debate in the year of 2007, I would applaud opening government for their incredible case. Unfortunately for them, we are having this debate in 2004. 24, that's it, 24. That was meant to be a great intro and now I fucked it. What is the status quo? Because opening government didn't respond to any of this. They got confused. They say bailouts are bad. We agree, so do most governments. And therefore, we are having preemptive regulations that happened post-2004 after we realized the problems that might exist because of interconnected banking that were put in place and will stay in place to prevent bailouts. That was our claim. What did we tell you? Vachi explained that in 128 countries, there are deposit insurances. Massive deposit insurances, mind you. About 150,000 of deposits get insured in the event of bank failure. The way this works is that banks pay premiums on the deposits to an insurance company that in the event that a bank fails, they pay it back so that depositors get their money back. Gut check this, right? They mentioned Silicon Valley. Did we see a 2008 scale financial crisis because of Silicon Valley? No. And the reason for that was because all of those deposits were covered by deposit insurance. That's exactly why. We also explained that we have things like capital requirements, liquidity requirements, a very much smaller scale of what they are proposing. We also explained that you have central banks that are willing to step in as a last resort in those cases. 2008 was an exception because of many different factors that played in terribly at the same time. We already have regulations. They did not respond to that at all. The second thing I want to explain is that these regulations are here to stay. We don't even have to prove that, right? Like there's a policy motion, technically a fiat. But like, I want to say even why they will stay. They claim lobbying. We gave multiple reasons why the lobbying doesn't work. The first reason is that the population still cares. People lived through 2008. It's a visceral memory for them. There is an electoral incentive both from all parties and all politicians to be responsive to that. Secondly, there's a bipartisan thing, right? Like bailouts are incredibly costly and incredibly unpopular for any party that would make them happen. Any party is destroyed just by the fact that a financial crisis happens during their time in power. What does this mean is that lobbying is just not worth it, right? Like, if you want to be a self-interested politician, you want to be taking some money from a lobby, you can take it from oil lobby, you can take it from gun lobby, you can take it from any other fucking lobby. You don't have to be taking it from banks because your career as a politician is not worth the lobbying that destroys that claim from Fauci. But secondly, even if you don't believe any of this, why are banks still not risky? Closing government says like banks expect to be bailed out. Again, Lehman wasn't bailed out. Banks don't know anymore that they would be bailed out. But irrespectively of that, first, we already explained that they are regulated against being risky. So that's enough of a reason, given how little response we receive, to believe that they are not doing risky things. But secondly, even if you don't believe any of that, banks have themselves incentive and capacity not to be risky. The first reason is that this is dangerous for banks themselves, right? Banks don't want to fail. Like their bonuses and like individual bankers, most of those people would get fired if they do a really risky investment. Lots of them don't want to be risking getting bailed out. This therefore means that banks do not want to be independently making those risk investments in the first place. But secondly, they have the capacity to make them. Banks can make loads of money, as Vachi tells you, with just a very low return, right? Like banks have a ton of money to invest. They can invest into things that are not super risky, but they still get loads of money back. This actually flips opening government because they are giving banks less money to invest. So with the money from the equity accounts, they will have to be making much more riskier investment, and therefore they are more likely to be failing on their side. But finally, even if you don't buy any of this, if you really, really, really don't like our case, the economy grows, right? Like the economy grows 10% yearly, or 5%. I don't know what's the number, but they grow because of technological development and things like that. So if banks invest into loads of different things, even if some of them are a little bit risky, just pays off by the fact that the trend of the economy generally just goes up. All of this means that the risk claims from opening government are nonsensical, same as if closing government wants to claim it as well. Because of that, the main thing is the massive harms they are causing to economic growth. Opening government claims loans still happen because now they reduce government bonds and therefore hedge funds will invest more into companies. That is nonsense. Got check that. Hedge funds don't invest into government bonds in the first place because they are hedge funds. They are doing things like shorting, investing into risky investments. But secondly, Vachi explains why the deposit money is the money that now is not going to get invested because it goes to treasury bonds. And because banks are the ones who are investing into the things like pension funds that they want to be investing into companies. None of that made any sense. We explained why this creates a massive harm in the form of reduced investment into companies, less liquidity into the market, because mind you, banks also do market making, right? They are like helping people being able to sell and buy, and like all investors, because they are the ones who are kind of buying and selling on time. So all of this means that they are reducing massively the amount of money in the economy. If any team, and like opening government kind of says, it says that governments get more money now because they are being put into treasury bonds. The first thing I would know that governments are much more investing it than banks, because they are often motivated politically, while banks are just motivated by making like risky, non-risky profitable investments. But also like the whole thing about strengthening treasuries are in demand anyway. You don't need banks to be putting all deposits into them because they are not risky. There's lots of investment on them already. Final thing then, but before I talk about preventing crises, I'm going to take closing. Opening
a position ignores analysis about the difference between short-term incentives, which bankers and politicians have, and long-term incentives, which they are hoping will prevent them from doing bad things.
But this would happen in short term, right? Like if you fuck the investment and you're causing a crisis, it will happen in 8 years within the thing. Like I gave you literally 4 layers of reasons of why it's not happening. They ignored those, not me. Second, why we prevent future crises? Because opening comment correctly identifies that there are many reasons why a crisis can happen. There is external to the financial system, or can be even within financial system. For example, because of the reasons that I described, that they are forcing banks to make risk investments. We are making the crisis better in case it does happen. The first reason is that the lack of capital also causes crisis and makes them worse, because now they have less investment into businesses. That means that if any crisis hits, businesses can't sustain operations. They have to fire workers. That's why deepens crisis. You get deflation spirals when people can't spend money because they lost their jobs, and then other businesses have to fire more workers, and then it all goes to shit. We are giving businesses more money, so you are preventing that kind of thing from happening. Secondly, you are preventing banks from being able to hedge against risks. Now they invest into diverse things, so they're hedging against different things that might be failing. Now they are giving them less money, so they're making them more risky. For all those reasons, I'm so proud of those.
I thank the speaker for the fine speech, and I invite the member of government to open the second half of the debate. Here.
All right, am I visible and audible?
Yep.
Okay, great. POIs in chat, please. I'll take one at around the 5-minute mark. Okay, cool. Speech starts in 3, 2, 1. I think the flaw with opening government, as opening opposition correctly points out, is that they take on far too high burden of a case by trying to prove this is going to prevent further government crises. Again, post-2008, there are generally mechanisms in place to protect that. We don't think this is where the crux of the debate lies. We think where the crux of the debate lies is simply getting more money towards governments. Lucy said that this isn't that big of an impact because, like, oh, you know, like treasury bonds are popular anyway, and like this just isn't that big of a deal. Firstly, like we just think that, like, given the amount of money that people have in banks, this is a pretty fucking big deal if, as they can see, the vast majority of it ends up going to government services, right? This is not like an insignificant, like $500,000. We're talking about billions and billions of dollars of additional spending and additional money that the government now has access to that they can then reallocate on their own terms. I'm going to talk more about why this is just going to be better off, but just like intuitionally, right? Like, yes, governments have better incentives, have political incentives, but companies have even worse incentives because they're using it for the sake of buffing up their own wallets, buffing up C-suite wallets for the sake of nothing but their own self-interest. We would rather a politically motivated government that instead wants to benefit the people to at least a certain extent, even if it's not to the same extent that we would like. All right, couple of things firstly then. Why would we rather just have more government bonds and more money given to the government? Like, one, right? The money given to, I think it's really important to outline the comparative as to where the money is otherwise going to go, where the money is otherwise going to go. Watcha tells us and gives us very helpful analysis as to why banks are generally risk averse, right? Why they're going to make relatively safe investments. If we take this as true, know that this analysis proves where the money is mostly going to be going towards big companies, right? Like index funds like the S&P 500, massive amount, like investments that are guaranteed safe because they are companies that are too big to fail, right? This doesn't look like investing in like startups and stuff like that because that's what venture capital funds do. It's not what big banks do because, again, they want to be safe. They don't want to have risky investments. This means that the vast majority of money doesn't trickle back down to people. There's 3 reasons why this is true. 1, companies have incentive to keep costs as low as humanly possible, right? Which means that if they could have cut more employees, they already would have cut it. They're already operating at the lowest cost possible, which means that now suddenly when you just have more investment. They're not going to hire more people because it's not necessary to increase their profits. They're just going to take the money and run with it and line C-suite pockets. But two, right, oftentimes the companies that these firms are investing in are already very, very big, right? There's not much room for further expansion because there's just not that many people out there to buy their products, right? There's only so many people in the world that can afford a fucking Mac. There's only so many people in the world that can afford like Windows products, for example. At a certain point, you kind of run out of consumer bases to explore. And these are the scale of companies that we are talking about, because these are the 500 largest companies in the world that banks are going to be investing in because of the fact that they want safe investments. So it's going to places that can't really expand more factories, that can't really make more clothes, because there's just a limit on consumer demand at the point at which at the scale of these companies. But three, we also think there's shareholder incentive generally, right, to line their own pockets, right? The banks are the shareholder. They have incentives to just get more dividends back to themselves instead of giving it back to consumers, giving it to workers, because it doesn't benefit them in any way, shape, or form. So we think that there are incentives to not have this trickle back down to the workers, right? What they then say is that, well, like we can maybe like, sure, the vast majority of loans are probably going to be going towards big companies, but we at least get some loans, right, towards mortgages and like loans towards small companies. One, I think that just like, this is probably the vast majority of loans that do exist either A, go to individuals who already have money, at which point the delta is pretty small. This just then serves their own personal financial interest when they probably could have been benefited elsewhere. But two, also in the cases in which they do give loans to other individuals, we think that these loans are predatory, and they have to prove that predatory loans are a good thing, which they don't necessarily do, right? Because if you have a fucking interest rate of like 30-40% on a loan because you have shit credit, I'm not sure that's necessarily beneficial for you, because that means that oftentimes that they're repossessing your capital. They can threaten and they can send debt collectors after you. I'm not necessarily sure if the policy that you are supporting under yours at the house are necessarily beneficial for all kinds of loans. I mean, the vast majority of money goes towards corporations, goes towards lining the pockets of corporate executives, and not actually back to the people, and not actually growing the economy. Note, panel, that the economy has grown in the past year, ever since the end of COVID-19. However, that has not been reflected in the increase of average salaries. There's a cost of living crisis across the world right now. So merely because there is economic growth happening doesn't mean that trickles back down to the people. I think just look at the world around you and gut check that right now. All right, why would we massively prefer this money to go towards governments? One, governments are at least accountable to the general population. Yes, Lucy, they might not always spend it in the best way possible, but they are at least going to spend it in a way that benefits the populace and doesn't necessarily just line the pockets of corporate executives, because they have electoral incentives, right? They want to say like, hey, look, we've like improved the NHS, so people are more likely to vote for them. They want to say like, hey, we've improved schools, so people are more likely to vote for them. They're likely to direct them in socially utile policies because that's who they're accountable to. They're accountable to the general public, and then they're likely to do it in these ways. But secondly, right, we just also think that having these bonds just frees up more money for governments. Yes, we agree that that governments aren't going to like be bailing out every single bank every single time, but governments do have to set a certain amount of money aside to bail out companies, right? Because of the billions and billions of dollars of savings that are often in these companies, that are often in these banks, they do have to leave aside billions of dollars of their budget, oftentimes just kind of sitting there in the case of an emergency, right? Yes, that might not seem like a lot in a country like that might not seem like a lot, but $1 billion could be what easily funds, for example, a new social renovation program, or for example, increasing teacher salaries so we solve the teacher crisis, right? There's a lot of small policies that can make people's lives massively better that don't cost a lot of money, but that we can now do under our side of the house. Yeah, sure, go for it, OL.
Okay, so your opening claim that this is going to suck up treasury bonds out of the economy so no one else can buy them, does therefore suggest that someone would have bought them despite of this policy? So who is right, opening government or you?
We think that like, under our best case scenario, governments are probably going to respond to the idea that we think that when governments see that there is an increased demand for treasury bonds, they're likely to create more of them, and so we think that we can get more government spending under our side. We don't think this is contradictory towards opening government, because like just if the government doesn't do anything, yeah, they'll probably have all their treasury bonds locked up, but we think the governments are going to respond to the influx of money they're now getting, and then therefore like, you know, sell more treasury bonds because it's just in their interest to do so. They just get more money to do so. All right, so again, we like, and we also just think that there are probably still attractive investments because of the fact that you just get a guaranteed 5% interest on them. This is just a good investment for individuals. So we think that under our side of the house, what you get is more government spending to free up on social services. Note the specific imperative on opening opposition and probably on closing opposition as well, is that money goes towards investors, that money goes towards people who are already the top 1% of society. On our side, even if it's marginal, you at least get benefits towards those who are the worst off. You get more spending on programs, especially during times of crisis. The problem that occurs with a lot of crisis relief bills is that people say that they don't have enough money that's going to cause them to go into a lot of debt in the future. We have now literally the option to create a massive new pool of money for the government to take on, and mean that any government that doesn't do so will be absolutely foolish. For these reasons, so very proud to propose.
I thank the Speaker for the fine speech, and now invite the Member of Opposition here.
Hi, can everybody hear me if I speak like this?
Yep.
Thank you. I'll take a few eyes in chat, please. One at a time. Closing opposition will win this debate in 3 ways. Firstly, we will win against closing government by proving why giving governments the potential to access vast untapped amounts of capital is actually a bad thing, because it leads to a perverse incentive to increase interest rates, as well as bad government spending that is worse macroeconomically. Secondly, we will win over opening opposition by proving why, even if you don't get regulation, why on our side of the house people are more likely to invest their money in the traditional way, thus empowering depositors, or why they are more likely to save their money, and why this is a preferable outcome to splitting investments between equity accounts and saving accounts. Finally, we will win against opening government through weighing. First, our unique extension in this debate will clash directly by closing government, by proving why this creates perverse incentives for governments to misuse the money that they receive in government bills. Closing government takes the incentives of governments for granted. But let's analyze carefully what governments are likely to do when they see that money can now be accessed if lots of people put their money into traditional savings accounts that must be backed up by government bills and bonds. Now, obviously, there's a concern in this debate about how many people will do this. But obviously, governments want as many people as possible to put their money into savings rather than equity accounts. This is because all governments just benefit generally from having more money available for government spending. It allows you to fulfill electoral promises. It avoids the opportunity cost of cutting money from existing government services, which would probably make people quite unhappy. The alternative in the status quo to doing what we're about to suggest the government will do is raising taxes. But this is, universally electorally unpopular, both among the average person as well as due to corporate lobbying and the government's desire to appease their corporate sponsors. You probably don't get an increase in corporate taxes or VAT or other personal taxes. So for this reason, what do we think the likely response of any government will be, particularly those governments that are poor and developing, where there are weak accountability mechanisms and poor financial regulation? We think that these governments will increase the base interest rate. Increasing the base interest rate, which is the rate of interest at which the central bank lends money to commercial banks, means that commercial interest rates rise. When commercial interest rates rise, more people want to save their money in banks rather than spending, because the return on saving money is greater. They think it protects their savings against the erosionary effects of inflation. So for this reason, there's an increase in saving, which also means that governments get a massive amount of money directly from commercial banks that are now obligated to back up their savers' deposits using treasury bills and bonds. Why do we think this is a bad thing? Firstly, this is a unique mechanism through which you massively increase the cost of borrowing for businesses and individuals. So an increase in mortgages, an increase in the cost of a housing loan, the increase for businesses that want to expand in getting access to a loan to be able to invest in production or hiring more people. Now, opening opposition tries to claim this benefit as well. But why do we think our mechanism is more important? The base interest rate is the universal metric by which interest rates are decided in country. Well, not universal, but it's the national metric by which interest rates are decided. Central banks have massive power over the commercial interest rate that is charged by banks, because the rate at which they lend money to the commercial banks is something that is totally within the control of governments. And in many countries where there is no separation of monetary and fiscal policy, this is something that many governments can easily access or influence, either by appointing people favorable to them to monetary boards or by directly controlling it in countries that have fixed initial or fixed base interest rates. So you massively increase the cost of borrowing in a way that is permanent and irreversible unless you are able to vote in another government. But we just want to point out, regardless of politically where you stand, this is an incentive that all governments have to be able to get more money for government spending. But secondly, we think that governments are also likely to do this during recessions and crises, when they can be seen to the people as actively trying to do something to build infrastructure or to prevent the, in the aftermath of natural disaster, to rebuild the country. The problem is, when you're in a recession or when you're in an economic crisis, that is when you most want people to be able to spend their money rather than saving. You want to be able to stimulate the economy. You want to be able to give people more opportunities for employment by increasing demand for businesses. But you cannot do this when a selfishly motivated government that has an electoral incentive to be seen as doing a lot now increases the interest rate, thus forcing many people to put their money in savings rather than actively spend it. So for this reason, you create a perverse incentive to increase interest rates, which hurts the economy. The second point in this extension will prove why the underlying value of treasury bills and bonds decreases. Closing government would like to paint a very rosy picture of the incentives of governments. But we in the developing world know that many governments use their money in deeply irresponsible ways. Many governments, particularly when there are poor accountability mechanisms such as weak democracies, are likely to use this on white elephant projects or to appease special interest groups at the cost of catering to the average voter. Why do we think allowing governments massive access to money from treasury bills and bonds decreases the underlying value of treasury bills? Firstly, the sheer scale of the funds available to governments just mean that they feel that they have free license to spend this money however they want to, even if it is appeasing to niche amount of the electorate who don't have an important effect on the macroeconomy. Secondly, governments know that they won't be blamed for a decrease in the value of treasury bills or bonds because this only happens in the long term, right? Treasury bills and bonds are long-term investments that are cashed out in like 5 years. So that government's probably going to be out of power. And even if people are angry about not receiving the money back from their treasury bill or bond because governments have invested it in failed ventures, that harms only future governments. But thirdly, spending more money means more opportunities for grift and corruption, more money to be able to pay off lackeys or state cronies, which any government, especially on an individual level, if you're talking about politicians and senators, have an incentive to do. The impact of this is you have more government spending, not on the things that are necessary for a government to be able to uplift its people, such as increase in employment, but rather on white elephant projects, grift and corruption, which is generally a bad thing. But more perversely, there is a massive increase in the instability and riskiness of treasury bills and bonds as an investment. The reason that this is so harmful is because in the long term, stable treasury bills and bonds is how you guarantee that you can make up the deficit between taxation and government spending. So in the long term, if people no longer trust the economy, trust the government, we think you are less able to fund important long-term government spending, which is what you need in order to be able to grow your economy. Briefly then on how we empower depositors. Opening opposition attempts to analyze why you have greater risk. But this is predicated on an assumption that banks just become generally riskier. We think banks also become riskier in far more specific ways, particularly for those few people who choose to put their money into equity accounts. Who are these people likely to be? Opening government would have you believe that these are people who have a high risk tolerance. But these could also just be desperate people who are either beguiled by banks into putting their money into equity accounts, particularly if they lack knowledge and information about how the financial system works, or because these people are so desperate for a short-term return and they see the middling returns that come now from putting your money in a savings account because you can only get money back from the interest rate from treasury bills. So these are particularly vulnerable people. The world becomes worse for these people in two ways. First, now the risky behavior of bankers is concentrated on a smaller number of depositors, given that fewer people put their money into equity accounts. So you have more concentration of risk, which means that these bankers now want to put your money in even riskier investments, and you can't diffuse the risk by having many depositors. So for that reason, we think these people are more likely to lose their money, and they're most vulnerable for these reasons. Closing opposition.
I thank the speaker for the fine speech, and I invite the government whip. Here.
Cool. Am I visible and audible?
Yep.
Sweet.
Wait.
Can I be seen and heard?
Yep.
CG has two claims. One, that governments are actually good at making decisions. Secondly, that government corruption can be mitigated because of the factors they're given. If I can prove to you in this speech that government corruption is as big a deal as we claim this is, and governments are not nearly as good at making decisions in a world where this motion passes, we take it over CG. If we're able to prove, as we already have, because there was no response to our argumentation on why banks become more risky, that banks do in fact become more risky, this takes us over OO, because OO only proves that banks are risky because of regulation. We will prove exactly why the incentives of banks change to become more risky. And thirdly, we're going to beat OG. So first, then in terms of bad government incentives, I want to note something here, which is that even if CG is able to prove that governments are generally good, that does nothing to prove against the analysis that Chanidu gave you, which is that the access to this amount of money in this particular way is what makes governments bad by perverting their incentives. I also want to note just factually, the vast majority of countries don't have independent central banks. The vast majority of countries, particularly in the developing world, don't want to be able to split their economic policy making from their governing, which is why the vast majority of politicians, even if they're not corrupt, don't want to make the central bank independent. So for the vast majority of people living in the developing world, the central bank is not independent. It's not independent in India. It's not independent in China. CG says they want the government to have more money. The government is fundamentally far more worse for creating jobs in the private sector. Governments do big projects that are easily mechanized, and because of lobbying, they're very much able to just put this into very specific industries. Compare this to the private sector, where all the money you put in doesn't quote unquote go to the 1%. It is invested in a business which then has to expand production, which means you have to create more jobs. Maybe this is less jobs than the government creates, but if we are then claiming that governments are more inefficient than private companies in that they hire more people, this is a bad thing, because it means that governments produce things at a much higher cost, which means it comes at a much higher cost to the taxpayer, which means that over time people's tax money is misused even further. Also, we think governments run out of their market base faster than the private sector, because the government often only provides necessities, whereas the private sector provides recurring expenses that people buy over and over, like food, for example. So lastly, if their claim is that you can invest in foreign bonds, CG also doesn't gain the benefit of governments getting money, right? So what you then need to just debate this on is whether or not you're giving this money to your own government. Let's then talk about why governments don't lack the money right now. The problem is that the vast majority of money is misallocated, not that the money does not exist. Governments are the biggest money holders of any agent in an economy. But as Jonathan told you, because democracies are often extremely weak, because they have the ability to invest in white elephant projects, because there's often rife corruption, particularly in the third world, the vast majority of money is misallocated. Why then is there a specific perverse incentive to misuse this money? Governments want people to save now because they want to encourage people to save by raising interest. Thereby, in times of an economic crisis, they're going to encourage people to save when people actually need to spend. CG says government will avoid this because they want to avoid the macroeconomic impacts. However, this can no longer happen. In the current world right now, you can have people spending, but have some people buy the government bonds. However, right now, the vast majority of government bonds, because it's the value of everyone saving in the economy, are directly tied to people's savings. So the only real way for governments to get sufficient amount of bonds, as OG told you, because the amount of bonds gets sucked up, is by particularly increasing the amount that people save. So even if they don't want to make this bad economic policy, they have to, because they now have no other choice to be able to get these bonds. What are the impacts of this? One, massively increasing the cost for people, which leads to massive inflation, and during a recession, absolutely crippling the economy. But even if you don't buy that governments are going to make this bad decision, there are two other mechanisms Shanidhu gave you as to why this is still bad. One, because this decreases the value of treasury bills and bonds, which means you're unlikely to be able to fund important projects in the future. And two, that there's more room for corruption when government spending increases, and thereby you're less able to have scrutiny over this. Why does this weigh us over OO? OO proves to you that you don't grow the economy. We prove that you actively shrink the economy. So OO proves to you that yes, maybe people don't get more jobs or get more money, but that matters to people a lot less than losing what they already have. What we do is we prove that you actively lose jobs, which is why we go over OO. Why do we go over CG? One, it doesn't matter how much money is being given to the government if the government is actively spending this on bad things. Second, you are dependent on the government for loans now, as Shanidhu said, which is why in developing countries, you're more likely to have government oppression when the government controls who gets the loans and who doesn't. But thirdly, governments have to sell the treasury bonds on both sides. It is only on their side of the house that in having to sell the bonds, they also screw over the rest of the economy through macroeconomic outcomes. Second clash as to why you have more risky banks. This is where we specifically beat OO, because OO only proves that regulations exist. We prove that regulations exist, and that is, while correct, a reason not for why this gets worse, but rather as to why it doesn't exist. we will actually prove that that risk gets worse and people are actually more likely to lose money in a world where this policy goes through. Here's a specific analysis why. For people with money in equity accounts, who are they likely to be? Trying to explain to you that these are likely to be extremely desperate people, people who need this money most, or people who need a very large injection of money as a result of their loan, which are most likely to be people who own and run businesses. What does this mean? It means that the only pool of money that banks can use to gain a massive return on is owned by the people who are the most vulnerable and have the most dependence on them. What does this mean? When banks are no longer able to gain a massive benefit from being able to use all of the money they get, they are only able to use the small amount of money in the equity account to gain a benefit, which means they're likely to invest in the most risky potential investments because of the small number of investors. Therefore, what happens? It means specifically that the business owner, the family man who needs this for his college kids' tuition, are the people who, yes, need it most over time, but also are the people who are the least likely to be, or most likely rather, to lose all of their money. This therefore means that there's a massive increase in risk in the economy generally, which hurts every single person. So it's no longer just a harm or there is a potentiality of having an economic crash. It is an almost guarantee that in having to make these risky investments, a large number of people who need a large amount of money are going to be the ones who lose out. Let's do it. Why do we waive OG? OO sufficiently responds to them. OO proves regulation exists. OO sufficiently therefore proves that OG's claim is not the strongest in this debate. Why do we win over OO? We can credit them for this good argument on the supply of loans, but we go further. We prove that banks become more risky, and we prove not only that the economy does not get bigger, we prove that it actively gets smaller and people lose out, which is a much bigger harm. We win over CG because even if they prove governments get money, they do absolutely nothing to prove why, as a result of this specific policy, government incentives are not changed to be perverse, and therefore they do worse and do worse things with this money. It is for all of these reasons you will vote CO.
I thank the speaker for the fine speech, and thank everyone for this great debate. Just want to check, in terms of the recording, did Heather consent to the recording? Because I remember CG said they did not consent, but I remember it was recorded.
I didn't consent, no.
Okay, so Theodore, please remove the part that has Heather. So we will now deliberate. Thank you for the debate. Please leave the room and see you later.